Hey everyone, third part of our three-part series with Jonathan today, and this is the one you should be looking forward to. It is where are the greatest opportunities coming? And we're gonna look into our crystal balls, which are as good as yours, and we're gonna talk about the big boys like Blackstone and Invitation Homes because they are clearly making moves already. And then what does that mean for mom and pop? I really consider Jonathan the big boy, and I'm the mom and pop, so we're gonna pontificate about what's going on.
So
And let's welcome Jonathan to the show. How you doing, man?
great. I'm not a big boy. I just buy bigger stuff. That's all.
Well,
When I
I
buy it, if I buy it at all. I mean, it's, yeah.
yeah, a lot more zeros on your transactions than
Uh,
mine. So let's talk about this. Let's start with the big boys because I think it's very clear, right? Blackstone, Invitation Homes are public, so you can read their quarterly filings. They're obviously somewhat opaque, but if you do it long enough, you can see the moves that they're making. And what I've seen from Blackstone and Invitation Homes is they have raised, not are raising, have raised billions of dollars, and they're starting to make plays. Both Blackstone and Invitation Homes. Any preference on which one we talk about first?
it doesn't matter to me.
Yeah, so
So
let's talk with Blackstone. I think that one's the most clear. They just reported their quarterly earnings, and what they have said in their quarterly earnings are they have record. And this is amazing for Blackstone because they are the multifamily. They are the real estate investor hedge fund, I guess you would call them, private equity. They have a record pipeline for deals in the next quarter or the quarter that we're currently in. And when I heard that, I read that, I was like, what are they buying? It's, in my opinion, it's got to be distressed hotels, maybe retail,
yeah,
because I don't think there's enough pain in multifamily yet. But I wanted to talk to you about that and see what you thought when you hear something like that from Blackstone.
yeah, no, that would be my guess. My guess
Right.
would be that they're looking to buy, distressed assets or looking to, there's some really sophisticated moves that people can make where they're not even necessarily buying them. They're recapitalizing the deals. They're kind of
Recap.
stepping in as like a white knight to save assets, or just topping up the equity, right? So uh, they can get control of assets for very little money
Exactly.
by doing that without even making a purchase, right? Just going in on the capital side.
Yeah.
So I think that what they're looking to do is probably cherry pick some really good assets for the long term, that are going to perform, once coronavirus is dealt with, that are going to perform really, really well. It's kind of a once in a lifetime opportunity to pick up, some really good hotel assets, maybe some office assets as well.
Probably. Yeah.
Some of the better performing, retail assets. And we've been, everyone's talking about how awful retail is. There's still some really
Yeah.
good performing retail assets out there. So I think that that's probably what they're looking, and I'm sure if they can find some decent deals on industrial or multifamily that pop up along the way, they'll take them. But I really, if they're raising a fund now, if they're looking at deals right now, those are the deals to be had. And maybe they're thinking at some level also like, hey, we expect to see some pain with multifamily coming down the road, and we're going to do the same thing. We're going to cherry pick some prime assets and kind of bite the bullet for a couple of years, but knowing that we're going to, over the life of this hold, we're going to do really well because we're going to buy these things super cheap. So that's my guess.
Yeah, my guess again with Blackstone is exactly right. They are willing to pick up. I think they're going to be picking up the Class A of Class A of Class A. They're going to pick up the top 2-3% assets, and they're going to put them in a structure that they're willing to lose money for 2 or 3 years. But their time horizons are longer. Their pockets are deeper, and Blackstone, 2030 is going to be just be bigger than they are now. That's just how they look at it.
But I'd be willing to bet that at least some of this is going to be going in, as I said, like with bailing out the owners rather than buying them out, right? And
for sure.
So in that way, I mean, their risk is really limited, right? Because they can get control of these assets for just very little money, and I think you're gonna see this happening.
And again, the other thing that Blackstone has is the reputation, right?
Yep.
Like Warren Buffett does in the stock market, Blackstone has it in real estate, and they are often the first. Like if you have a Class A asset in trouble, you're very likely going to call Blackstone probably in your first 3 phone calls saying, what can we do? So they're going to get the phone calls first. They're going to be able to put this structure together where, again, to your point, probably relatively speaking, very little out-of-pocket capital. And some of these, I bet you they're going to start buying debt at discount.
Oh yeah,
for sure.
Oh, absolutely. I mean, I'm sure this is part of that play, looking for distressed notes. They can restructure the notes, and I mean, I think there's just so much there that they can do.
And then the other thing, just on Blackstone, before we go on to Invitation Home, is reputation matters. Whether you're the size of Blackstone or you're mom and pop in a market, if your reputation is out there, there's nothing better than getting the first dibs on an opportunity, right?
Absolutely.
Yeah. All right. So let's switch to Invitation Home. Like Blackstone, they're public. They call their shots. I watch Invitation Home because, again, they are the largest owner of single family homes. By last count, they had 80,000 single family homes.
Wow.
It's amazing. They have just already, again, raised a fund to go get another 20,000, at least 20,000 homes. Wow. They want to get to 100,000 single family homes. Again, usually in the biggest markets, think Phoenix, think Dallas, think Austin. They're very kind of, concentrated kind of in the South. But I think what this is telling folks is Invitation Homes sees strong returns with single family rentals. They've proven the model, right? Warren Buffett in the Great Recession said he'd buy every single family home if he could prove that it would, be a model that's scalable. And Invitation Homes said, "Oh, good idea, Warren. We'll go do that." And when I look at people, putting tens of billions of dollars to work, I feel good about my little onesie twosie single family home edition. So I don't know if you track Invitation Homes at all, but I think they're sending a message.
Yeah, I mean, and look, this is just reflecting what we're seeing, which is, this change in consumer preferences to lower density, right? And maybe some of this, as we talked about previously, it has been pent up and was coming anyway, and should have just been a gradual trend that we would have seen. It's all coming at the same time now. But I think that they are smart in trying to get out. I think this is a sort of 2 or 3 year opportunity.
I agree.
I think they're getting out ahead of this now, and they have the ability to raise a lot of money very quickly and get ahead of it.
Cheap money.
And so I think this is very smart because this is clearly, for at least the next couple of years, there's a large percentage of the population that wants to get into a house, and just because of social distancing and because of just having more. If you're stuck at home, you want more space to spread out.
Space is good.
Yeah.
Space it is that
have yard. You want to have no common areas with other people who may not be
as hygienic,
as diligent as you are. Right.
Yeah.
So I think that, if you can raise that amount of cash, gives you incredible power to move, gives you incredible power to buy, not just move fast, but, outbid people for the best assets, or come, buy cash, come with the best terms. You can go and tell a homeowner, "Hey, we'll close in a week." No
appraisal condition.
Everyone else is going to take, 6 weeks to 2 months to get a mortgage and do everything. And you can just go in there and say, "Look, cash in the barrelhead, write you a check on, next Monday." And it's hard to
powerful.
do that.
Yeah,
it's powerful.
Exactly. Yeah. So this is just fun to watch. And the other thing again, I watch single family home market. Forbes magazine just put out a hottest market, 15 hottest market. I did a video on it yesterday or the day before. And it's amazing to watch the markets that are hottest. They have days on market sub 10 single family homes. Amazing. Wow. They've had inventory drops as high as 83%. Boise, Idaho, down 83% inventory. Days on market 9.
Wow.
That is hot. Now, some of that's the big boys, Invitation Homes. Some of that is, Zillow and these other, pay cash for your homes. But yeah, single family homes in the suburbs, no big markets, no Chicago, no San Francisco, no New York, no Dallas, no Austin, no Seattle, no Portland. We're in the top 15. It was all suburbs. Like, space is good. It's just amazing.
But there's probably also like a data issue or a statistics issue there too, right? Because if you've got smaller markets, right, it doesn't take a lot more demand for that to happen.
True.
Right? If they've only got 100 houses on the market at any given time, it's different from a market where there are 10,000 houses on the market at any given time, right? So the amount of influx that has to happen to really move the needle is a lot less people, right?
True.
So
Very true. Yeah.
so
Statistics again
yeah.
if you don't understand the basis of the statistics, it can sort of swing your opinion. So now let's swing to mom and pop, whether that's, mom and pop coming into a syndication for a apartment asset, like I believe you've just closed in Atlanta. I think that just closed. So we can talk about that. And then mom and pop single family home investors. I think Blackstone and Invitation Homes are sending signals if we choose to watch on what mom and pop investors might be doing. You have any thoughts there?
Yeah, no, I mean, I think, it's only the zeros that are different, right?
Yeah,
It's,
for sure.
it's the play can be the same, and you can do this on a smaller level, right?
Yep.
You can do it with one or two. You don't have to do it with 20,000.
Mhm.
I think that, there are some, let's talk about sort of short-term versus long-term opportunities, right?
Yep.
I think short-term, we've talked about this before. If you can find a good house to flip in a hot market, I mean, do it. Like that is, if you're really, it isn't just, say, the north to south move, or the California to Texas move. It's also the, like downtown San Francisco out to the suburbs move,
Absolutely.
right? It's New York to New Jersey. It's New York City to Westchester, New York, or Long Island, New York. This
Just so you know, Westchester was on the list of the top markets, just so you know.
Oh,
Sorry.
was it really? Oh,
It was.
interesting.
Yeah.
Yeah. Well, I'm not surprised, right? So, just given sort of what we're seeing. So if you get, if you have access to a property, and I think it's going to be very tough to buy anything that's turnkey right now. That's probably not the play.
No.
You want, and I think the opportunity here is that people who are desperate to leave and go buy a house want to buy it right now. They don't want to go and buy a house that they're going to have to renovate for the next year.
Exactly.
Especially with the demand. I mean, that's another issue here, is like getting contractors, because there's so much demand on their time right now. If you can get yourself a fixer-upper, right, that looks hairy, not a light flip, because everyone's buying that. And people, maybe some people will be willing to buy that and renovate as they live there or whatever. But I'm talking about like something with hair on it, and you have some access to contractors, you can do the work yourself.
Yep.
Like, absolutely, you should be throwing yourself into this right now.
Totally agree.
In these markets, this is a great way to make some money. Another thing, vacation rentals, right? People, especially if it's on the water somewhere where people want to go, and especially if it's on the water someplace where people want to go that they can drive to from a major city within a few hours, because people are social distancing out there. People are quarantining out there in vacation rentals. People are doing long-term vacation rentals right now, because if they can't buy a house in the suburbs, they don't want to buy a house in the suburbs, but they do just want to get out of Dodge for a while, they're going to these, rural, or vacation rental locations and renting houses. And in addition, for the regular sort of vacation stuff, look, you can't fly to Europe right now. You're not flying to Vegas right now. You're not, all the places that people are normally going, they can't go. So where are they going instead? They're going like to the lake. They're going to the beach. They're going to the mountains, because that's pretty much all they can do right now. So, I mean, I'm feeling really happy about this house I just bought upstate, because it just realized that it's within about a 4-hour drive of like 30 million people. Right?
There you go. Yeah.
And so it's, it's a good location and it's a beautiful location, and it's, wine country and stuff. There's a lot of draws to this area. But if you can find something like that too, I think this is a good opportunity. As always, don't overpay. Like, don't get ahead of yourself and say, oh, it's worth it overpaying for this asset because of all this good stuff that's going on. You can still, if you overpay, you can turn a good deal to a bad deal, right?
Absolutely.
But so don't overpay, but there are opportunities in this area for sure.
Yeah. So let's go to the syndication in the multifamily retail office. When you think about what's coming, are folks like you kind of raising funds to maybe step in like Blackstone is to debt, or is the value add play that was been all the rage for the last couple of years kind of played out? I mean, how are you looking at that kind of market?
Value add is dead. Value add is dead as a doornail right now, because nobody wants to take the risk.
People need to hear that. I don't think people hear that. Value add is dead.
Value add is dead. Because nobody knows where rents are going. Nobody can, is comfortable underwriting rent growth, we don't know if you're going to get your $200 or $300 rent bump, right, if you do the renovation. So people are looking for turnkey assets right now. And so renovation plays are not really happening. Now, this could lead in maybe a year or two to some real bargains for those assets where you're going to be able to buy them really cheap. But this whole idea of you're buying like a, you know, you're buying a essentially outdated property at a 4 cap because you believe you can put in $1 million and raise it to an 8 cap because you're going to get these rent bumps. That's not happening right now. And, you know, those deals are not getting done. But again, what goes around comes around. Those assets may fall out of favor. They may start getting really cheap. And when they do, then they're going to be good plays to buy. I think another thing to be looking at is, look, we've got, right now, everybody's looking at what's going on with people leaving the urban cores and moving to the suburbs. And, you know, the typical investor psychology is nobody wants to live in the city anymore. The cities are dead. This is going to be like New York in the 1970s again. And like nobody wants, it's not happening.
No, I agree.
But the psychology is there, which means that there will be bargains to be had. And I'm starting to think about, you know, all right, let's look at New York. I mean, it's a place that I live here, but I've never invested here because it's always been too expensive. Cap rates are too low. It's too difficult to deal with tenants. But look, it gets cheap enough.
Yeah.
And you can deal with all that stuff, right? Because then the headaches become worth it because of the amount of money there is to be made. So
yeah, I'd love to ask you about that. Let's stay there just for a minute. Cause like you, I think again, my market, San Francisco, I mean, they're kind of equals just on different coasts. I do believe San Francisco is in for an amazing amount of pain, but like you just said, I think there's at a point where prices get adjusted low enough where the stress and fear of owning that asset gets big enough. Cause again, it's amazing, right? People are lemmings. They just go and it's binary, right? Never live in the city, always live in the city. Never live in the city.
Not just that, but there are going to be foreclosures and pain,
for sure,
right? Because people who bought at the top, you know, now they're seeing like asking rents drop by 20%.
Dude, 31% in San Francisco.
Yeah, there's going to be some pain. And actually, I have a broker's license, and I just got an email yesterday from, there was a blast email that went out from the real estate licensing board in New York State that put a cease and desist order on essentially people like going door to door in certain neighborhoods in Brooklyn, trying to like offer people money for their houses on a distressed basis.
Oh, wow.
Because it's already starting. Like people are all the kind of vultures are already looking around and going, you know what? People are in pain. They're behind in their mortgages. I'm going to go buy myself some cheap stuff. And so the licensing board has already said, hey, brokers, knock it off. So
amazing.
Yeah. So I think that and San Francisco, every big city is going to be the same. There's going to be the smart people are looking around and saying everyone else thinks the city is dead. That means there's bargains to be had.
Yeah. And what I wanted to ask you is, because I agree with you all of that, but I timing is always the important, right?
Timing is always the important thing.
I'm guessing 18 to 30 months out is kind of where the max pain and bottom might be interesting. It's certainly not tomorrow's, I guess what I'm saying. Like,
yeah.
the pain's just starting.
Yeah. And I think people can bear the pain for a while too, right? They'll, you know, pay that additional part of their mortgage out of their pocket for a while and continue to hope that they're going to get a new tenant in. But there comes a point where either they just run out of money or they just don't want to put up with it anymore. And it's often, you know, the way things work, it's often like right before things are going to turn back up again.
It's so true.
That people give up, right? And if they just hold out for a little bit long, either they should have sold really soon and gotten out then, or they should just hold on just a little bit longer. But usually what happens is they, right at the point at, you know,
maximum
right
pain,
before it's about to turn back up again is when they give up. And you know,
you're so right. Again, I've been very clear. My most active and most profitable year was 2010. And if you would have just held on one more year, you would have seen that, you know, you've had 12 years or 11 years of rise. So it's pretty crazy. So again, I think Blackstone and Invitation Homes are sending signals I think Jonathan, you and I are licking our chops by what's coming. I think there's lots of things we could do. So I appreciate you. 3 videos today, man. Thank you very much.
Absolutely. It was fun. It was fun.
Thanks, buddy.